The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it is time to talk about money. We're going to be shifting radio programs or radio stations later in this month. In a couple weeks, we're going to be going to KFLE, which is The Answer. So I'm thinking about calling the program The Answer About Money. We'll see. Anyway, we'll be on a different station, and we'll be coming just on Saturdays. Right now, we broadcast this very same program on Thursday. It's live on Thursday. It's repeated on Friday and Saturday evening. Next, in a couple of weeks, will be just Saturday. So do tune us in on KFLE and stay tuned. Anyway, I want to start today by talking about 3 questions. Think about these questions. How would you answer these questions? And these are kind of math questions, but think about this. If a ball and a bat together cost $1.10, you go to the store, you buy a ball and a bat, and you pay $1.10. And you find out that the bat cost $1 more than the ball cost. Then how much did the ball cost? Keep that in mind. How much did the ball cost? Second question is, if it takes 5 minutes for 5 machines to make 5 widgets, how long will it take 100 machines to make 100 widgets? If it takes 5 minutes for 5 machines to make 5 widgets, how long will it take 100 machines to make 100 widgets? Keep your answer in mind. We got a third question. In a lake, there's a patch of lily pads, and every day the patch doubles in size. If it takes 48 days for the patch to cover the lake, how long will it take to cover half the lake? Got that? We're set? We've got answers to the 3 questions? Now, most people will answer the first question, the ball cost 10 cents. If the ball and the bat together cost $1.10 and the bat cost $1 more than the ball, most people will answer that the ball cost 10 cents. But if that were really true, then that would mean if the bat cost $1 more than the ball cost $1. If the ball cost 10 cents and the bat cost $1, that means the bat would only be 90 cents more than the ball. So the answer to that question is that the ball cost 5 cents and the bat cost $1.05. Think about it. The bat is $1 more than the ball, so the bat cost $1.05 and the ball cost 5 cents. That's the answer to question 1. Question 2. If it takes 5 minutes for 5 machines to make 5 widgets, how long will it take 100 machines to make 100 widgets? 5 minutes. Think about it. 5 machines can make 5 widgets. It will take 100 machines 5 minutes to make 100 widgets. You have 20 times as many machines. Final answer. If there's a lake with a patch of lily pads and every day the lily pad doubles in size, how long will it take for the patch to cover half the lake? If it took 48 days to cover the entire lake, how long will it take for it to cover half the lake? Most people divide the 48 and get 24, but that's the wrong answer. You know, if I'm asking a question, that I've got a funny answer anyway. But it takes 47 days for it to cover half the lake because it doubles in size. On the 48th day, it doubles from having half the lake to the full lake. All those questions, fewer than 1 out of 5 people get all 3 right. But that's a lot of what people do with financial planning. They look at financial planning and they look at it without really reasoning through what's right and what's wrong. You know, when I started AFC in 2005, I thought we were going to do some financial planning. I paid for a big chunk of money to get the very best financial planning software. I sent my sales assistant to school and paid for a week or almost 10 days, actually, for her to be trained on how to run the whole thing. And when we produced our first report, it was over 400 pages long and it had pie charts and graphs and more colors than the rainbow has. It looked beautiful, but it was wrong. And so I started this. That was back in 2005, but I thought it's time on the radio to do a series. And this is the third in this series to talk about what's wrong with financial planning. The plans that are produced are beautiful. They look wonderful. They're produced by the computer. They take your data, they massage your data, and they produce great reports, only they're wrong. And there's a number of reasons why they're wrong. In fact, it's probably going to be a 5-week series to talk about what's wrong. The first week I talked about what's wrong if you look forward in the forecasting, because if you look forward, they simulate doing a Monte Carlo simulation, what's called a Monte Carlo simulation, to forecast the probability of what the probability is that you'll run out of money. How much do you have to put away? If you put away more, can you reduce the probability? If already you're 100% sure that you're not going to run out of money, maybe you want to save less. It produces all those answers. But it's based on a bell-shaped normal curve. And I used the example of 1987, saying if the bell-shaped curve had been right, the odds of having an October 19th, 1987 were octavantrillion, 2.57 octavantrillion to 1. That's 2.57, a 2 with 87 zeros following it. It took me a long time. I didn't even know that number, and I didn't know there were 87 zeros. If you look at a trillion has 12 zeros. The odds against what happened on October 19th, 1987 are better than a 1 followed by 87 zeros. Not very often. It's probably never going to happen in our lifetime again if that was really true. But that was an extreme, maybe an approximation. But the fact is, when 2007, 2008, 2009 came along, a lot of people found that their financial plans really didn't work. Retirees had less than they planned. Some had to go back to work. Some had to reduce the amount of money they had. I know of families where the students had college funds set aside, had planned to go to a certain college. They didn't have the funds to go there. They had to go to a different college. Pre-retirees ended up having to work longer than they planned. That was the problem going forward, is it's based on something which is mathematically incorrect. And not only mathematically incorrect, in fact, to be sure, it was incorrect in forecasting. Last week, I talked about looking backwards, because looking forwards is one direction, looking backwards is the other direction. And I use the phrase GIGO. And you know what that means, garbage in, garbage out. If you put in garbage into the computer, you're going to get garbage out. And the question is, what is the historical return that you look at? And I believe that history doesn't repeat, but that it rhymes, and there's a lot of lessons you can learn from history. But if you put in bad numbers from historical perspective, you're going to make bad forecast. Now, the average stock return, just looking at stocks, not bonds and cash and the other things that will go in, but if you look at the average stock return from 1928 to 2014, the average return has been approximately 10%. But if you look at only the last 30 years, it's 8%. If you look from 1982 to March of 2000, it's 12.9. And if you look from March of 2000 to March of 2009, it's a minus 6.9%. So what you choose going backwards is going to affect what you choose going forward. You know, the difference between 8% and 9% over 20 years is going to add 19% to a nest egg. So if you plug in 8% and forecast that out for the next 20 years, and then you compare that to putting in 9% and forecast that out for another 20 years, the difference between those two numbers is 19%. That's huge. How do you plan around that difference? So that's just in terms of the stocks. If you look at bonds, you have the same issues. If you look at inflation, you have the same issues. If you look at commodities, you have the same issues. If you look at real estate, you have the same issues. If you look backwards, it depends upon the numbers you use, and generally, you're not going to be very accurate in forecasting. So not only do you have a problem looking forward, you have a problem looking backwards. But today, it's a question of the financial allocation and asset allocation, because that's part of financial planning, is to spread and diversify the portfolio between different asset classes. This is the third in the series, in which I call 10 is the new 4. And we're going to come back and discuss that right after the commercial break, so don't go away. We've got a lot to cover today, and I've got a really impressive guest. Stay with me.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Off today.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been doing a series on what's wrong with financial planning. Today is the third in the series. And we have some music in the background. Maybe I'm being serenaded. Maybe somebody really likes the program and serenade. I think that the music has now disappeared. But anyway, now we'll talk about the third aspect. What's wrong with financial planning? The idea of financial planning derives itself from the fact that people want to know where they are in the future. But there's part of it that is related to people and their risk tolerance. There's a game that's been set up and it's been run by several people to demonstrate something. And the game is people start with $20 and there's 20 rounds. And each round is based on a coin flip. You get $2.50 if heads come up, and you lose $1 if tails comes up. Now it's in the best interest to play every single time, because you've got a 50-50 chance to win $2.50 as opposed to losing $1, which means you have every time a better chance to win than lose. But about half the time you're going to win and half the time you're going to lose. Half the time if you win, 10 times you flip heads, you're going to come up with $25, and half the time you're going to lose, you end up with 0. So it means that you have a gain. There's a 13% chance, and only a 13% chance, that you end up with less than $20. 87% of the time, you'll end up with a gain. But in experiments, only 58% of the time did people play the entire game. Only 40% after they had a loss. Think of it as people understood far back. They were thinking, having seen the coin come up tails once or twice or three times, they were done. They were not going to lose any more money. They were going to take whatever they had and go, even if they were at a loss to begin with. And as the game progressed, people invested less often. That principle applies in financial plans because it's built to reduce the amount of risk. That's the idea of the financial plan. You've seen the pyramid, I'm sure, that shows that down at the bottom you have very safe money, and then above that you have less secure, less safe money, but not hugely risk. And as you go up the pyramid, the risk increases at each step. And at the top of the pyramid may be commodities, maybe stocks, whatever it is, depends upon who's drawing the pyramid. But stocks are considered pretty risky, and bonds are not quite as risky. And if you do something like CDs or treasuries, they're at the bottom. They're the safe thing to do. Annuities. For many people that use that pyramid and sell on that pyramid, annuities fall in that bottom category. And I'm going to talk later in the program about annuities. That's coming later on, because I also believe that I would rather die than sell an annuity, but I'll tell you why later in the program. That's coming. But when you look at that pyramid, what you're doing mathematically means that you have to put more aside. If you look at what you get, if you take $100,000 and invest it at 9%, that's going to turn out to be $1.6 million. 1.6, actually 1.66. If you invest it for 40 years, it's going to turn out to be $2.83 million. That's at 9%. But if you invest that at 4%, you have a big cut in what you get. So that's the difference between those numbers. When you're looking at a financial plan, you're allocating some money to bonds, some money to stock, some to cash, some to annuities, some to whatever. You're putting more money into the safe money, saying that's what you need to be safe about. And then you can take risk with the others. But what that really means is mathematically you're investing in something that's 1%, something that's 3%, something that's 5%, something that's 9. And when you add all those together and take the average, it comes out that you're getting a 4 or 5% return instead of 9%. And what that does over a period of time, the difference between getting 10% over 25 years and 15% over 25 years is 3 to 1. The difference between 5% and 10% over 25 years is 3 to 1. Invest $10,000 at 5% over 25 years, and you end up with about 100,000. No, my numbers are completely wrong. I have to recalculate the numbers. Anyway, what I'm trying to say is because of what the asset allocation does is the return is significantly lower. And that return, we looked at the difference between 8 and 9% over 20 years, reduces the return by 19%. Think of what the return is if you go from 9 to 5. It's very significant. That's what I call the 10 is the new 4. There was a time when for retirement savings, people were putting away 4% into their retirement plan. And that was usually a defined benefit plan. 4% going into their retirement benefit plan meant that when they retired, they had 80% of their income. Today, with the way asset allocation and retirement funds are set, you have to put away 10% to get the same kind of income. That's an issue with financial planning. It really is a negative. It takes you more money, and at the end of the day, you're going to have a higher withdrawal rate or a lower withdrawal rate at the end. Financial planning's wrong in that aspect. It doesn't make sense. There's better ways to do it. There's much better ways to do it. But it goes back to this idea that on the short term, it may be safer to do asset allocation because the assumption is that if one of the asset classes is down, another will be up, and they'll balance each other out. So you'll end up over the long term with things balancing out to come out to an average. The fact is we saw in 2007, 2008, 2009, we saw that every asset class fell. Real estate fell, bonds fell, and stocks fell. It was not a very pretty situation, and commodities caved in. That is not the right approach if you're looking to the future. So that kind of wraps up the third thing. I will come back and talk about one of those safe things to invest in, which I don't believe is safe at all, annuities. That's coming later in the program. But right now I want to introduce my guest, Kathy Flood from Cascade Game Foundry. Welcome to the program, Kathy.
Oh, thank you very much.
Why don't we start with your background?
I grew up in Iowa, went to college there, came out to work for Microsoft, started my own company after having been at Microsoft for almost 19 years, and I've been doing that for the last 8 years.
So at Microsoft, what were you doing?
The last 14 years I was there, I worked on video games, so PC games and also Xbox 360, Kinect. So I got to see a big evolution of technology. And prior to that, I worked on operating systems, so Windows and all the way back to DOS 5. OS 2, I think that was what I was working on when I first came to Microsoft. So I got to work on a lot of evolutionary software over the years.
So in that process, Microsoft was going through some changes as well, right?
Oh, absolutely. Yeah, I think there were only 4,800 people when I started, and around 100,000 around the time I left.
And within the video game segment, there were changes as well.
Oh, yeah, definitely. When we first started working on games, I kind of got reorged into games. I was working on online technologies, and that got folded into what they were calling kids and entertainment or something, and then they called it kids and games after that. So that was very PC focused, all about building things to show off what the Windows operating system can do. And then when they switched to doing a console, building their own console, then the shift very much went to more strain entertainment and not necessarily taking advantage of what the computer can do so much as what that individual platform can do. So the Xbox and the Xbox 360, which were their own beasts. So we were a little separated from the Windows centric part of the company at that point.
And then there were changes that went on in the organization.
Absolutely. So, reorgs were very common there the whole time I was there. And as the company got bigger, they happened a lot. The biggest one for me was when the economy crashed and there were cuts across the board at Microsoft, and our entire studio, which was working on flight sim and train sim and simulation technologies outside of the entertainment space too, the entire studio was disbanded. So that was a shock.
And that's when you left Microsoft.
Yes, that's when I left, and I kind of took it. I'd been there for a long time and loved it. Got to work on all kinds of really interesting things, but there were some things that I'd wanted to do on my own too, and I kind of took that as impetus for going out and doing that on my own, and that's what I've been doing ever since. And
that led to Cascade Game Foundry.
Yes.
We're going to get to that because we are coming to a commercial break. And you will find these programs on our website. The new website is launched. You can check adamsfinancialconcepts.com. You want to come back because we want to hear about Cascade Game Foundry. I think it's very fascinating, interesting to hear. So don't go away. Keep us right here on the dial. We'll be right back.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm here with Kathy Flood of Cascade Game Foundry. We're going to talk about the game. So tell us what the game is.
So we have a conventional game that runs on regular Windows and Macintosh computers, and it's a scuba diving simulator. So you do what real divers do. So you keep track of your air, you find wildlife, find artifacts, you learn about the local people, local culture, the marine biology of an area. So we try to make it as accurate as possible to show you what it's like to be in the ocean, and hopefully you'll be inspired to protect the ocean.
And to become a scuba diver.
Yes. Well, we don't want to replace real dive training, but this will certainly introduce you to the concepts that you'll have to learn about as a diver. There are a lot of parts of getting certified as a diver that are not very fun, so we didn't want to put that in the game. Nobody likes it when their mask fogs over, for example. So we say we're the real world on a very good day.
So you have to clear your mask when it fogs over.
Yeah, that's not so much fun in the real world. So we concentrated on the things that make us want to go diving again. So the surprise of seeing new wildlife or finding something you've never seen, just seeing what interesting creatures are beneath the surface of the water. One of the things we've discovered we do a lot of school outreach, so talk to kids about making games and about why we made this particular game and why ocean education is important. And even here in a coastal state, there's so many kids who have never actually been to their own coast, let alone gotten in the water. They really don't know what's there, and this is a way for you to learn about not just what's in your own water, but what's in the water around the world, and why it's important to keep those animals safe and healthy, because it keeps us safe and healthy.
Yes, it does. So it's a scuba diving platform.
Yes.
And you go scuba diving where?
So the two sites we have released so far, one is a World War II shipwreck in Micronesia. So the dive sites are real. So they're the right depths, and the shipwreck is the way it looks. If you were to go diving in Micronesia on the Gosai Maru, this is what it looks like. And all the wildlife is specific to and accurate to those areas too. The second site is in Belize. It's Glover's Reef, so southern Belize. And that site was picked out by Dr. Sylvia Earle, who is a famous oceanographer and a National Geographic explorer in residence. And she's one of the elder statesmen of the marine environmental movement. And that's one of her favorite spots because of the whale sharks. So you get to dive with whale sharks there.
Oh, that's interesting.
So, and then the third site, which we're still working on, is actually in Puget Sound. So the Salish Sea, as we call it, the area that we share with Canada, the inland waters. So we're really excited about that, especially because we talk to so many students in this area. And again, they don't necessarily know what's in their own waters. And this is a way for them to learn about that.
And the life in the waters is incredible. It
is. In fact, this area is considered sort of a gem in scuba diving circles. It's cold, but there's a lot of very healthy life around here. The most beautiful corals, believe it or not, and every bit as colorful and various as what you see in tropical waters. It's just that the visibility is often considerably less,
it's
a lot colder.
Yes.
So not as many people brave getting in the water, but if you do, it's worth it. It's really stunning.
So the second game that you produced is a virtual reality game?
So what we did, we took a slice of the Belize dive site. The Belize dive site is quite large, and it provides a lot of territory to explore. We took a small slice of that and turned it into a virtual reality experience. And in that, you are diving with Sylvia Earle. She's your dive buddy, and that's a bucket list item that a lot of people have, that they want to go diving with Sylvia. So we made it possible for you to do a little 5-minute dive with Sylvia. And again, this is in Belize, so all of the wildlife, the fish and corals, invertebrates, are things that you would see if you were really diving in Belize. And they're kind of companion pieces. So the regular game, you can play with a regular computer and a mouse and a keyboard. You don't need a headset. The virtual reality is built for the Oculus Rift, so it needs a very high-end computer and a headset, touch controls. But it's very immersive. It delivers on the vision of the game in a really powerful way. One of the things we've been surprised by is, even though it's a very small in relation to a giant dive site, the VR is a relatively small experience, but people react very emotionally to it. We always get a good response to the conventional game, but when people put on the headset and look around, and they feel like they're 60 feet underwater. They feel like there's a manta ray swimming above them, that they've got a light, they can look inside the sponges. And they take the headset off, and people some of them have cried. We've gotten applause just for doing the demo. I mean, it's very, as well as our regular game comes across, the VR just inspires something really emotional in people. And that's exciting to see. And there's starting to be a lot of research now that shows that people have more empathy for the situations, whether it's walking through a slum in Calcutta or being in the ocean. You have more empathy for a situation that you've actually been surrounded by yourself, as opposed to just seeing a photograph or reading a story about.
And for those people who aren't familiar with virtual reality, when you put on the headset and you're immersed in that dive.
Yeah. So if you've seen a video game on a flat screen, you know what that looks like. So it's often difficult to describe to people what the VR does, but inside that the headset, if you're talking about an interactive VR, so this isn't Google Cardboard. Nothing against Google Cardboard or any of the phone-based experiences, but there's only so much computing horsepower that's available on a phone. If you're in an interactive VR experience, you're on a very high-end computer, and you're able to really give the illusion that you are somewhere else. You forget that you're sitting at a chair with your feet flat on the floor. You think you are floating on a reef, and everywhere you look, you're actually in the water.
Yeah.
And it's hard to describe until people try it, and then they go, "Oh, I get it." And that's one of the challenges, I think, for the VR market, is that there's a lot of confusion as to what is VR. Is that something that you can do on a phone? And you can do some types of, you can watch videos and have some smaller experiences. But the really interactive experiences that you are part of the environment and that your presence in the environment matters. You've got a light, so you can actually look behind something. You can't do that in a movie. In a movie, you're limited to the angle that was shot and the lighting that was shot. With us, we've got a light, so if you're in the cave, you can look around with the light.
No, so VR, you fool your mind into believing that you're really there.
Yeah.
And you sense that. You feel the emotions, you feel the excitement, you can feel the danger, you can feel all those emotions.
It's a really powerful technology, and we're pretty grizzled. We're jaded, honestly, as game developers. We've been doing this for a long time. And the first time we got our own stuff running, and the first time we saw some of these demos, it's very inspiring. It makes you go, oh, what else can I do? Where can I go that I can't get to ordinarily in my daily life? I can do so much here. I can provide an experience to someone that may not be able to have it any other way.
So how would somebody set up the game? The game is free for teachers and students?
Yes, for teachers and schools. They just have to go to our website, so infinitescuba.com, send us email, and we just find out what school you're at and then give you access to the game. The VR is on the Oculus Rift store, and all the proceeds for that go to Mission Blue, which is Sylvia Earle's ocean awareness organization.
So spell Oculus Blue. Oculus.
The Oculus Rift.
Oculus Rift.
So if you OCULUS, is that right? Oculus, yeah.
Okay.
Gotta spell. If you just go to infinitescuba.com, the links are there to the Oculus store, and the conventional game is available on Steam. And part of the proceeds from every copy of the game we sell too also go to Mission Blue.
And you can play that on your smartphone, on your tablet?
You can play the conventional game on Windows and Macintosh computers and laptops. We don't run on phones.
Okay.
There's too much happening there to cram that onto a phone. And then the Rift needs a computer and an Oculus Rift headset.
So again, where would they go to buy the game? To
InfiniteScuba.com.
InfiniteScuba.com.
Or go to Steam and look for Infinite Scuba.
Sounds great. Thanks for being on the program.
Thank you so much.
So if you've seen advertisements on CNBC, you've probably seen Ken Fisher, who says, "I would rather die than sell an annuity." So why would he say that? You know, annuities are sold as being something very safe and very secure, guaranteed. You know, what's the deal? I started talking about asset allocation. The first part of the program, I said the returns are lower if you do asset allocation than if you do something straight investment. But, you know, I tend to agree with Ken Fisher. I'd rather die than sell an annuity as well. There are places where it's needed. I had a cousin, for example, who worked for the government. They didn't have a lot of income. They didn't have a lot of nest egg. And when his father died, they inherited the house and they sold the house. They got a big chunk of money and they went through it. They spent it in 2 years. So he got a settlement from the government because he was injured on the job. Came to me and said, "Would you invest the money and grow it?" And I said, "You know, the best thing you can do is to do an annuity." The reason is because they'll have the money for the rest of their lives. They'll have an income for the rest of your life. That's where an annuity applies. But we sell the annuities to a wide variety of people. And the only people who benefit are the financial advisors and the companies. How is that so? Well, let me tell you about that. That's coming up right after this commercial break. Don't go away because you need to hear this. I'll be right back.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So, annuities. There's very, very few people that should have an annuity. Helen Olin wrote a book called Pound Foolish, Exposing the Dark Side of the Finance Industry. And she said there's two things about annuities. First, they're increasingly sold to baby boomers who are worried about running out of money. And secondly, they're so complicated, so difficult to understand, so many financial penalties that they're very, very difficult. Even Susie Orman, and she's not one of my favorites, I don't agree with a lot of what she says. Even Susie Orman and many other experts say don't do an annuity. Annuities are sold for one and only one reason, and that's to make money for the financial advisors and make money for the insurance companies that do them. It's rarely in the best interest of the people who buy. Some, and I gave the example of my cousin who really needed it, but for the most part, annuities are sold to people who shouldn't really have it. You know, there have been studies that have been done. A guy out of Harvard devised a sample portfolio, sent actors to financial advisors, and those advisors recommended things, and they refused to correct the client investment biases. These actors went with a script, and they didn't read the script, but they went with a script of what they were supposed to say, and they said some things that were wrong. The financial advisors didn't correct, but very often they would steer the person toward annuities. Why? Because annuities pay a lot. Annuities run anywhere from 4 to 10% in commissions. They're a hard sell. The financial advisors are really well rewarded. There have been times when annuity sales dip where the actual payout to the financial advisor can reach as high as 14%. That's not typical. 4 to 10% is more typical. And even when they're 4 to 10%, they're usually being paid to the company. It's the financial advisor that may get 4%, but the company he works for gets 3 to 5 to 7% as well. And they are sold as a safe thing. You know, the actual way in which they're sold, and there's no such thing as a free lunch, but many investors, many, especially baby boomers, will attend what's called a free seminar, and it's almost always the same pattern. The Securities and Exchange Commission and FINRA have said that over half the flyers are misleading. The flyers will say they're low risk. That's misleading. They're based on creating fear. And 9% of the people who attend that free seminar, 9% will buy an annuity. And the pattern's always the same, always the same. It's scripted and it follows the same pattern. The pattern is to make people sweat a little. You pose the same problem in the same way, and the solution is the annuity. The word annuity is not mentioned as the solution, but that is the solution. The idea is to sell the idea, will your retirement survive an economic meltdown, for example? Can you go through another 2008 or 2009? Will you have enough money to retire if we drop 30% or 40% or 50%? What happens to the money you set aside for retirement? Usually, the slideshow is 20 or 25 or 30 slides long, and they show what it's like to face a new retirement. What do you do when you're retiring? These are the transportation costs that are going to increase. These are the medical costs that are going to increase. These are the hospital times you're going to be in. That's statistically you're going to be there. This is what it's going to cost to be in a nursing home. This is what it's going to cost to be in independent living. These are all things. And what happens if we go through another great recession? What happens? Will you have enough money to retire on? You know, the whole idea is to create a fear that people are going to run out of money. And 9% of the people will key in on that. 9% of the people will buy that annuity. Seniors are very much the target group. And 20% have inappropriate investments or paid significantly higher fees than they need to. And of course, this investment is, the annuity, is always sold as something that's guaranteed. They never go broke. They're told that. This is guaranteed. And most investments can't be sold as guaranteed. You can put your money into a bond. It's not guaranteed. You can put money into stock. It's not guaranteed. You can put your money into something like an annuity, and it's guaranteed. But let me tell you, insurance companies do go broke. Executive Life was the largest in California, 1991, and the state took it over. First Capital Life invested in junk bonds to put out the income to their annuitants. They went under. Mutual Benefit Life really shook the world because it was supposed to be conservative, it was blue chip, it was solid, it was A+ rated, and it went under. First Capital Life, of course, had also been rated A+. Executive Life had been rated A+. And what happens during those times are the payments are frozen. Extreme hardship, people get paid some, but it's not guaranteed. Eventually, people have gotten their money from these companies because they set up a fund, just like the FDIC has a fund. But payments are reduced. Some payments are frozen. Sometimes instead of giving, if you're supposed to get 6%, sometimes you get 1.5%. Baldwin United, 1987, actually was acquired by MetLife, but they delayed their payments for 4 years. And then only the minimum payments. If you read an annuity contract, it says this is the minimum we can pay. In the case of Baldwin United, it was 1 or 2%. That's all they paid. And they delayed for 4 full years. They're not FDIC. It's an insurance industry backing. You know, I call it a chocolate-covered hand grenade. It looks so good, but it blows up. You know, there are a few appropriate cases where it makes sense. But even then, you know, there are bells and whistles that are usually added. There's inflation protection. There's this protection. There's stock market participation. The stock market participation is limited, for example. You get stock market participation up until 7% or 8%. But look at last year. The market was up 21. So you get to participate in 7 or 8%, then you're capped out, and the insurance company gets the rest. Oh yeah, you're guaranteed on the bottom, but if you look at it over long term and you're in the annuity for 10 or 15 or 20 years, there's going to be complete recovery during that time. The people who make money on these are the financial advisors and the insurance companies. There's one and only one reason they're sold, and that's for the financial advisor and for the insurance company. They're a horrible investment. They're horrible. The returns are horrible. You know, when you look at the returns, already you're paying 2% just for the insurance. It is, as Ken Fisher says on TV, I'd rather die than sell an annuity. I think that really caps it up. We're going to be talking more about financial planning and the problems with financial planning next week. So be sure to tune in and join me as we talk about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only. Any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review.